we'll have to grant that.
Okay. All right, thank you. Questions or comments? Senator Galgiani.
Hi, Senator.
Hi. So there have been several pilot projects for coming up with new ways for short-term credit. Do you think those have been successful? Are companies participating with those, and are people actually using them?
So people are actually using them. We will be coming out with our report the 1st of July to the legislature, and that was part of the results of the pilot program. Around 200,000 loans so far. I can give you some preliminary data. That's a good start. We have 6 companies that are participating and 1 more that is currently we're reviewing to possibly approve. And I will also tell you, so any of our existing CFL licensees or consumer finance lenders licensees, we're talking to them about offer a pilot program product. Apply for the pilot program, offer a program. It doesn't have to be your whole business, but it can be part of your business. And it's kind of this little marketing thing we're doing to try and get the participation, more participation up. $200,000 loans sounds like a lot. In California, that's not so much. Mm-hmm. So we are working on it and working with the legislature and talking a lot about them when we're out.
Okay. Are there concerns that after the outcome of the new policies that there might be companies that would leave California and leave less options for those who need access to the credit?
I don't think so. I think California is still a market. I feel like you're giving me a softball, Senator. 35% of the people of the state of California are either unbanked or underbanked. Underbanked means that they only have a checking account, mostly because they have a checking account to get paid. Mm-hmm. There's an incredible market here in California. We're huge. We've got to get the law right so more people will come in, whether it's in California as well as the CFPB, so more people will have access to capital and access to the financial products they need.
Mm-hmm. Okay, thank you.
Thank you, Senator. Any other questions or comments at this time? Seeing none, I'd like to thank and excuse you. Appreciate your testimony as always.
Can I sit for a while and then leave?
You can sit as long as you like. You're excused from that chair.
I'm out. Thank you, Senator.
Thank you. And with that, I don't want to proceed without thanking our staff person on the Banking Committee. Eileen Newell has done an incredible job putting this all together, getting a lot of the witnesses who we're going to be hearing from today here, and creating what I think is a very powerful agenda. The agenda now is divided up into 4 more groups. Each group will have 25 minutes. 4 groups divided into 2 panels. The first panel will be talking about the short-term loans that are covered by the CFPB proposal. First, the consumer perspectives, then the business perspectives, industry perspectives. And the second panel will be looking at the long-term loans, 2 groups, industry perspectives first, and consumer perspectives after that. So the first of these 4 panels coming up will be Paul Leonard, Director of the California Office, Center for Responsible Lending. Leanna, and by the way, I'm sure there's a question for you from Senator Morell.
That could be Tom Leonard.
Leanna Molina, who is an organizer with the California Reinvestment Coalition. Leslie Bailey, Staff Attorney for Public Justice. And Ted Merman, who's Executive Director of Public Good Law Center. The 4 of you will speak in that order. Again, you have 25 minutes as a group, so I would ask the speakers to each take no more than about 5 or 6 minutes so everybody gets a chance. We begin with Mr. Leonard. And by the panel, the questions you may have will be for committee members at the end of the panel. So we'll hear from all 4 people, and then we'll have questions. We'll begin with Paul Leonard.
Mr. Chair, Paul Leonard, I'm the California Director of the Center for Responsible Lending. We're a national organization, a policy and research organization that's focusing on eliminating abusive lending practices targeted at low and moderate income families. The center is a 10-year-old national organization. We work in many states across the country. We have an office here in California. We're also affiliated with Self-Help, which is the nation's largest community development financial institution, and operate 20 branches of a retail credit union around the state, a full-service retail credit union. Thank you very much for holding this hearing. I want to hew closely to give you reactions, CRL's positions and reactions, but I would be remiss if I didn't include just a few key data points. I also want to say that I've presented a voluminous written testimony for your consideration that includes many our views on many details of the proposal, so I just want to hit the high points today. With respect to data, I think the data is pretty clear that the sequences that Mr. Salas talked about result in real debt traps for a large proportion of borrowers. And let me give you just a few. CFPB data says 80% of borrowers reborrow within 2 weeks of getting a payday loan. Our own data, and similar to what the CFPB has done, says that while this is a 2-week loan, the typical borrower is in debt for 7 months out of the year under these payday loans. And new DBO data that came out just last fall really reiterate the notion of the debt trap here. They show that 76% of all loans go to borrowers who are taking out 7 or more loans per year, and that 60% of all payday loans here in California go to borrowers who are taking out 10 or more, which by our calculations are averaging 13 loans a year for those 10 or more categories. We've included a chart in the testimony that shows that distribution that comes from a licensee survey that the DBO has been doing for the last couple of years, and which really adds to the depth of our knowledge about what's happening in the program. CFPB's main goal with these proposed rules, I believe, is to break the debt trap, ensuring that borrowers either directly have the ability to repay their loan without being forced to default or to reborrow. To address this shortcoming, CFPB primarily relies on requiring lenders to determine that borrowers will be reasonably able to repay the loan based on verified income and verified major financial obligations that a borrower has. This ability to repay requirement is particularly important for payday loans, where the market incentive to underwrite is flipped on its head because the lender holds first-in-line access to the borrower's checking account, either through a paper check or through an ability to electronically debit the borrower's account on payday. In this context, the lender isn't counting on the borrower's ability to repay the loan, but rather the lender is counting on their ability to collect on the loan through this leverage of being able to be first in line to collect. Whether or not the borrower can actually afford to repay it, indeed because substantial lender revenue is derived through loan flipping, which occurs when the loan is not affordable to be paid off and meet other financial obligations, the lender actually has a disincentive to lend to borrowers who don't have the ability to repay the loan in full, but rather enough to pay it off and borrow back again and generate another fee. So CFPB for these short-term loans has created a sort of a two-tiered approach to this, the so-called debt prevention and debt protection. Either they do full ability to repay underwriting, or they will allow 2 spells of 3 loans each, separated by at least 60 days with no more than 90 days indebtedness over the course of a 12-month period per borrower. To mitigate the real harms to borrowers that we have seen for years, we strongly encourage the CFPB to eliminate the debt protection option altogether. We strongly believe in the universal application of ability to repay, whether it comes to mortgages or to payday loans. We recently studied loan performance of payday loans made in North Dakota, a study that was cleverly labeled Payday Mayday, and found that 40% of all borrowers there defaulted on the first or second loan that they took out, meaning that ability to repay would affect a large number of borrowers who are taking out a loan that they cannot afford to repay. Other key issues with the CFPB's rules, we strongly support the short-term loan flipping protections, which are the rebuttable presumption of an additional loan that's taken within a 60-day window. We also strongly support the 60-day cooling off period for borrowers who have taken out three loans and met that rebuttable presumption test of documenting their changed circumstances. And finally, we support that 90-day indebtedness standard being applied to the ability to repay provision so that there's a backstop and to ensure that the ability to repay regime is effective in breaking the payday debt trap that the CFPB is trying to talk about. I'm going to stop there and turn it over to the others on the panel at this point.
Thank you.
Great, thank you so much. I'm Liana Molina. I'm with the California Reinvestment Coalition, also known as CRC. We're a statewide membership-based nonprofit advocacy organization committed to increasing fair and equal financial access to banking and other services for California's low-income communities, communities of color. Our members are affordable housing developers, housing counselors, small business technical assistance providers, community development financial institutions, legal services providers, and other practitioners who see firsthand the needs of economically marginalized communities across our state. Throughout the years, we've worked with our members and allies in dozens of California cities to educate policymakers and the public on the harms of predatory payday lending. Numerous cities ranging from Sacramento to Fresno, San Jose to Long Beach, and many other jurisdictions have enacted local ordinances to prohibit or restrict the expansion of payday and other fringe financial entities. Local governments have also have done so on the premise that payday lenders and other high-cost companies pose a threat to the public good, erode the quality of life in our cities, and strip away the income and assets of vulnerable consumers, while also creating an economic drain on families and communities. These local efforts are also partly in response to the state legislature's failure to advance strong consumer protections, especially in the payday lending market. We know from the DBO's annual reports, the CFPB's reports, and countless other nonpartisan research organizations that short-term high-cost balloon payment payday loans do create long-term cycles of debt for most consumers. That's why we optimistically welcome the CFPB's proposal, and we're heavily invested in ensuring strong rules are enacted and that loopholes that would enable high-cost debt trap products to continue to harm consumers are closed. We're encouraged by the broad proposal that the CFPB has put forward, and we know that when consumers are treading tumultuous financial waters, payday loans are like an anchor which only sink consumers deeper into debt and oftentimes drown them in a cycle they cannot escape. We share a similar analysis and echo many of the same concerns that our partners at CRL have outlined, both in their oral and written testimony. I personally have been leading CRC's campaign to reform high-cost payday lending since 2008, and during that time I've sat and met with several consumers and heard heartbreaking stories of how their lives have been impacted by financial debt traps. This afternoon I'd like to share a brief case study with you which demonstrates why the CFPB rules are so urgent and important, and why we believe that mandatory ability to repay requirements are absolutely essential for any meaningful reforms. Currently, it's very easy, perhaps too easy, to access payday loans and other extremely expensive forms of credit. The overproliferation of these storefronts in low-income neighborhoods, coupled with the complete lack of underwriting standards, ensures that anyone who wants money in their pocket right now can get some. As long as they have an income and a checking account. It doesn't matter if their income isn't enough to meet their basic necessities, or if their only income is a public benefit such as unemployment or Social Security. It doesn't matter if their bank account balance is consistently low or entirely empty. These things do not matter to payday lenders because they always make sure that they get repaid first, since they have the direct access to the borrower's bank account. While the industry argues that they are doing working people struggling to make ends meet a favor by extending them credit, this easy, unbridled access to credit is often to the detriment of unsuspecting consumers. This type of easy credit is hurting hardworking people like Carmen Munoz and Davina Esparza, who have both struggled with triple-digit interest payday and installment loan debt for years on end. Carmen and Davina both reside in East Los Angeles in Senator De Leon's district. Carmen is currently unemployed, and her unemployment benefits ended on April 27th. She did clerical work for a law office for 18 years before being laid off last October. She specifically assisted their attorneys working with clients on debt collection issues, so she has some familiarity with lending and other debt collection practices. However, that didn't help her from falling into a bottomless financial pit. At one time, Carmen had 4 simultaneous payday loans from Advance America, Ace Cash Express, PLS, and Speedy Cash, all storefront lenders located in her neighborhood. Each of these was for the max of $300. At the same time, she had 2 internet loans, one for $300 from a United loan and a $1,000 loan from AmeriLoan. And on top of these, she also had 2 installment loans, a $5,000 loan from Cash Call and another $8,000 loan from Springleaf Financial. So Carmen carried her multiple payday loan debts on a consistent basis from about 2007 to 2012. And during this time, she estimates that she paid over $14,000 in interest and fees, not including the hundreds of dollars that she lost in overdraft fees to Bank of America. She permanently forwent her home telephone and cable television services and even had her water shut off at some points. In 2012, she received an email solicitation from Payless Financial advertising their loan consolidation program for consumers with 3 or more payday loans. In an effort to deal with her overwhelming payday loan debt, she signed up, and that's how she finally escaped her payday loan nightmare. But it wasn't without negative consequences. Carmen had to close her bank account. To this day, she still uses prepaid debit cards for her financial transactions. Though the phone calls from the payday lender stopped, Payless Financial failed to provide her with any documentation verifying her account details, and her credit score plummeted from 620 to 104. She's still struggling to pay off her Cash Call and Springleaf Financial loans. Right now, she started paying her Cash Call in February of 2007. When she's done, in August of this year, she will have paid $16,478 to borrow that $5,000. This is unconscionable. These industries are running amok, and they need to be reined in at all levels. While Carmen's situation is extreme, we know that this is a common experience for people mired in high-cost debt. Carmen's case illustrates why lenders should be required to assess the borrower's ability to repay any and all loans, factoring in their income, their expenses, and debt obligations, as well as their borrowing history. Furthermore, we need tools to enforce our existing state law and the CFPB's proposed rule that specifies consumers should only be able to access 1 loan at a time. Too many people like Carmen are in over their heads with multiple loans that they cannot afford and shouldn't have been given in the first place. This is why we need both the ability to repay requirement from the onset plus additional debt protections, not optional underwriting that most lenders will opt not to do. And I'll go ahead and end there. I know Eileen will be including our written comment in your packets. Thank you.
Thank you, Ms. Molina. Ms.
Thank you.
Bailey.
Thank you, Mr. Chairman, members of the committee. I'm with Public Justice, and Public Justice is a national public interest law firm. We represent low-income consumers, and we bring impact cases to fight corporate abuses. And we've represented consumers in a number of cases across the country against payday lenders, where we've obtained some of the largest settlements in the country and returned tens of millions of dollars back to borrowers from lenders who broke the law. I'm here to tell you that the CFPB's proposed regulation of payday lending is absolutely a good thing for California consumers. And the reason is very simple. Because state law does not always adequately protect consumers, and it doesn't always give them a way to get their money back when they're cheated, even where the laws themselves are written as being more protective. The reason for this is that payday lenders have a very long history of finding loopholes for avoiding state law. For example, when states capped interest rates, payday lenders affiliated with out-of-state banks in an attempt to export those higher interest rates from the bank's home states into the states that were more protective of consumers. Courts and regulators saw through this rent-a-bank scheme, so payday lenders went looking for another loophole. They later disguised themselves as credit services organizations, or CSOs. And the California legislature, along with some other states, figured this out and put an end to it. Now, lenders have found yet another loophole in Native American tribes. I currently represent a class of California borrowers against an online out-of-state payday lender, which is one of a growing number of lenders who are seeking out tribes in an attempt to borrow the tribe's special legal status. These lenders approach a tribe, and they offer a small token percentage of their profits, we've often seen 1%, in exchange for an arrangement in which paperwork is drawn up to make it look as though the tribe owns and controls the lending business, when in reality, the business is funneling all of the profits away from the tribe into the coffers of the original lender. And the purpose of this setup is to later persuade a court, should consumers be wronged and sue to get their money back, that the lender is actually part of the tribe and is thus entitled to tribal sovereign immunity. Now, courts across the country, including the California Supreme Court, are grappling with this issue, and it's a very difficult task for a court to try to determine who is a real tribal entity and who is a rent-a-tribe scheme. And of course, where the lender actually is the tribe, because tribes are, under the law, sovereign nations, there's absolutely nothing we or anyone else can do to help those consumers under state law. So that's why the CFPB's proposals are so important. These proposals will level the playing field. For the first time, borrowers will be protected from all lenders, regardless of where they are, whether the lender operates online, or whether they're tribally owned. And so this will fill what is currently a huge gap in enforcement and protection. And it's absolutely essential that there not be carve-outs in the CFPB's rulemaking, because if, for example, tribal lenders were to be carved out, you can rest assured that we would see an even greater proliferation of lenders claiming to be tribal. Now, I know that there are very valid reasons that tribes want to go into the payday lending business. These are often disadvantaged communities, and they need a revenue stream. And I've seen arguments that it'll be very detrimental if lenders have to comply with the federal laws, that they won't be able to make enough money if they have to obey the law. But I would urge you to consider that when you look at many of these arrangements and you look at who's truly benefiting, it's hard to see any benefit to tribal members. A Business Week investigation of the defendant in my case revealed that this Kansas billionaire is getting increasingly rich off of the lending business and buying new Ferraris for his private race car team, while members of the tribe that supposedly owns this business are just as poor as ever. But more importantly, this is not a situation where we have low-income borrowers on one side pitted against the interests of Native American tribes on the other. Large numbers of low-income, economically vulnerable Native Americans who borrow payday loans need the protections in the CFPB's proposal just as much as every other consumer. The U.S. Treasury found that Native Americans and other minorities are much less likely to have bank accounts and much more likely to have to avail themselves of alternative financial services, such as payday loans, than white Americans. A recent survey of Native Americans found that when they were asked which alternative financial services were the biggest problems in their communities, 2/3 of them answered payday loans. And so the reason that the Bureau is taking these steps to protect these consumers is that they are very harmful no matter what the identity of the lender is, and to carve out tribal lenders would be a big mistake. The better course would be to empower tribes the way states will be empowered to enforce these regulations on behalf of their borrowers. And so to sum up, unless the CFPB's regulations are truly universal and truly apply across the board equally, they are not going to have their intended effect of protecting consumers, because law-abiding lenders will lose out, they'll lose revenue to their outlaw competitors, and wherever the loopholes or carve-outs are, that is where we will soon find the majority of payday lenders. Thank you.
Thank you, Ms. Bailey. Mr. Merman.
Thank you, Mr. Chairman. Good afternoon. Good afternoon, Senators. Good afternoon, Chairman DeBobney. Thank you for the opportunity to speak with the committee on a subject of pressing importance to our nation and our state. My name is Ted Merman. I'm the Executive Director of the Public Good Law Center and a Senior Advisor to the Consumer Law Practice at the East Bay Community Law Center, or EBCLC. That's the acronym warning, in Oakland and Berkeley. I also teach consumer law at the UC Berkeley Law School. Public Good has been involved in cases involving the financial products that we're discussing here today, including one now pending in the California Supreme Court. And EBCLC is the largest provider of legal services to low-income residents of the East Bay, home to a consumer practice that has seen thousands of clients since its doors opened 7 years ago. I will also offer input from other legal service providers around the state. So I began this process with the idea that payday loans must provide some benefits to go along with the vividly documented debt traps that those who work at EBCLC and in other legal service clinics around the state have seen, apparently, all too many clients fall into. It was my assumption that if there are more payday lending storefronts in this country than there are McDonald's, then they must be doing some good. So I surveyed my colleagues about their clients' experiences with short-term payday and auto title loans and what the impact of the CFPB's proposed rules might be. Here is how they responded. First, on payday loans from Oakland. Our client, and I'm quoting, Maria Gonzalez is 68 years old and receives as her sole income $1,759 in monthly Social Security. Over the last year, in order to help out her struggling granddaughter, Ms. Gonzalez has taken out payday loans. Indeed, Ms. Gonzalez currently renews 7 low-dollar loans every month. She has never defaulted on any of them. This means she has renewed multiple loans more than 12 times and has renewed every loan no fewer than 6 times. She pays over $500 in fees per month just to stay up to date with all 7 payday loans and has no way to pay them off because she could never come up with the necessary lump sum payments. And because her monthly living expenses exceed the amount of money that remains, she is being driven ever more deeply into debt. This is what the cycle of debt means. People are living on a fixed income or paycheck to paycheck, and the additional burden of paying back payday loans drives them over the edge. The CFPB proposal prohibiting concurrent short-term loans from multiple lenders would have stopped this cycle before it began. On auto title loans, very briefly, from San Francisco. Our client, Ralph Simpson, was homeless and living in his car. He had no income and yet somehow managed to get an auto title loan. Then, when the title lender came to repossess the car, Mr. Simpson was left with nothing. As another colleague told me, payday and auto title loans are the tipping point for real trouble. Clients already don't have excess income, and now it's redirected to trying to pay back an endless cycle of loans. To keep their car, which is often the only way they can get to work to make money, they will prioritize loan payments ahead of the necessities of life, ahead of paying for utilities or for groceries or for their child's dental treatment. The Bureau's proposal requires that both income and ability to repay be verified in the case of auto title loans. If that requirement had been in place, it would have saved Mr. Simpson's car. From San Diego, one lender charged an exorbitant interest rate for a series of loans secured by our client's car title, in addition to inaccurate and deceptive disclosures regarding the APR, hidden finance charges, and undisclosed payments to third parties. They even sneaked an unauthorized tracking device onto the vehicle during a, quote, inspection. This hidden tracking device is, of course, a violation of the California Penal Code. In that and the other enumerated violations, this example illustrates that the CFPB's rulemaking needs to retain its emphasis on harmonizing other applicable federal law and on not supplanting more protective state law. Instead, the new rule needs to set a floor above which states are free to go, as Commissioner Owen mentioned. There is perhaps no place more appropriate for underscoring the importance of respecting states' authority to offer further protections to their consumers than the legislature of the most populous state in the Union. On privacy, here's an issue that the CFPB proposal does not seem to cover. From Oakland, around 7 or 8 years ago, our client, Stephen Jones, I'm quoting, borrowed $250 from a payday lender. He made some payments but defaulted. Recently, someone has been calling Mr. Jones claiming the debt was transferred to them and that he must pay a substantially higher amount or the sheriff will pick him up. They have his birthday, they have his social security number, they keep insisting that he put the money on a prepaid card. They refuse to give him their company name or address. Mr. Jones visited the original payday lender and they confirmed that there is no record that his debt was sold. San Diego reports a very similar fraud campaign. The Bureau needs to provide measures that will ensure the security and the privacy of borrowers' personally identifiable information and financial information. The proposal as presented does not address these issues. These are just a few of the examples of the issues raised by payday and auto title loans among legal service providers around the state. And these are, in many cases, the front lines for dealing with the serious harm that this kind of law, these types of loans can cause. There are numerous other examples that my colleagues have mentioned, and I'm sure that the written testimony will also cover. And then I have to note there are examples of abuses in the context of longer-term covered loans as well. As it turns out, I learned in preparing for this hearing, legal service providers in the state see as many of those types of problems or more with similar grave concerns about affordability in particular. So I began this survey of my colleagues with an eye towards hearing not only about the abuses, but also about the people whom payday loans were actually helping. I wanted to hear the stories on the other side of the ledger. So I asked my colleagues, including one at the East Bay Community Law Center who used to run the housing clinic there for 17 years, whether she had ever seen payday loans work in the way they are marketed. For example, to tide a family over for a few days needed to make a rent payment and keep them from being evicted. I expected that my colleague would say she had.
1 minute.
These were the people that payday loans helped, even while there were many others who got caught in a debt trap. But that's not the response I got. This is what she said. I have never seen a payday loan solve someone's problem. I have seen people hurt by payday loans. I have saved these people from being evicted because of payday loans. I've heard clients talk about not having enough money for food because of them. And the cycle of taking out more loans to pay the interest is never ending. It takes a toll on people. We have to recognize that we have a problem. That's the only way we're going to solve it. It is my anticipation that we will look back wonderingly after this frenzy of the past couple of decades, as we did with liar loan mortgages and pay option arms, and ask, why did we let that happen? What were
Thank you, Mr. Merman.
that time has
I'd like to thank this panel and thank you all for your brevity and clarity. I will have a couple of questions, and the rest of the committee will have an opportunity to ask questions.